This episode of Top M&A Entrepreneurs is brought to you by the No BS proven 7 steps to buy $1 million business, helping first-time buyers with deal flow, deal review, deal financing. Learn more at dealflowsystem.net. Welcome to Top M&A Entrepreneurs. Today we're talking to Randy Wood, who sold his company to a Fortune 1000 company. Then he joined the company and has acquired 9 other companies. And we're going to show you the right characteristics to get your company acquired for top dollar. Before you do that, if you like this video, make sure you hit the subscribe button and hit the bell to be notified of the latest content coming out. Today, my guest is Randy Wood from Valtech. Randy has built a digital marketing agency, Nonlinear Creations, ran that for 23 years. Got it acquired by a very large 2,000-person company, and now he handles all the M&A for Valtech. Randy, welcome to the show.
Hey, good afternoon. Thanks for doing this, John.
Thank you for being here. So, Randy, let's talk about your journey. You started Nonlinear Creations 23 years ago, digital marketing agency. But, you know, that's not a lot of digital going on back in 1999. So what were you doing there?
So we started actually in 1995, and then we sold it after 23 years. So it's like 27 years ago or something now. So
27. Awesome.
A an old roommate and I decided that this internet thing sounded interesting. We didn't have any particular skills in the space, but then neither did anybody else because the internet was brand new. No one was quite sure what it was. So we quit our otherwise fantastic jobs and threw our hat in the ring, took our $500 in operating capital and one laptop and started a company. So that happened in 1995. And then for 23 years, we grew as the internet grew. And in 2017, we formally went to market to sell the firm. And the successful bidder was Valtech, which was a global digital agency. That was in 2017, about 2,000 people then, pushing 6,000 people now. So it's been quite a growth curve for them after we joined them.
Mm-hmm. Yeah. So that's kind of the focus I wanted to ask you the questions on. You've obviously built a digital marketing agency that was an irresistible buy to a much larger company. First of all, did they pay more than they normally would for a multiple for a company, or?
It's always hard to get comparables, right? Like it's private deals of this size because we were about 120 people. It's difficult to find out what everyone else has paid, but I feel fairly comfortable that we got, it was a very good deal for us at the right time. And I should be clear on what we were. So digital agency is probably accurate, but we really weren't involved in marketing deeply by the time 2017 came along. Initially, we were in 1995. By the time we reached 2017, we were technical experts in a number of technologies, including a product called Sitecore, which was rapidly growing, and we were growing with that product. And we had offices in Canada and the US, Brazil, and the UK. So our attempt was to sell to our customers in US dollars and UK pounds, and then compensate our team members in Canadian dollars and Brazilian reais, because that actually works in our favor from a currency perspective. Because we had that established group and established customers, and we were working with this technology, which was in high demand, we were attractive to Valtech, given that they saw this as a growth area and us as one of the few experts in the world in this technology. Does that make sense, John?
Yeah, you were, so Sitecore is a content management system. There's a number of competitors out there. Why did you decide to go after and, you know, choose this one? Because there's a lot of CMS systems out there.
You know, sometimes it's better just to be lucky than good, John. So way back in 2005, we had a content management area of practice. Way back in 2000, we were working with a company called Red Dot. We had partnerships with OpenText and Electron. We were at the Microsoft show in Boston in about 2005, and Sitecore had set up a booth. And 2 of the smartest people in this industry had just joined Sitecore. There's only about 7 people in the company in North America at that point in time. So we recognized these people. We knew them from the industry. We walked over and talked to them, and we thought, well, if all the smartest people in the industry are joining this company, we probably better pay attention. So we sat down there and signed a partnership agreement. And partnership agreements often go nowhere. But in this case, because the people that were there were well-intentioned, and because there was opportunity, we quickly turned that into a real business. And so as they grew as an organization, we were able to grow as well. So I won't tell you that we had this plan that they were going to become one of the dominant players in the space. It was more like we liked the people, we liked the product, and we saw the opportunity, and we happened to walk past them at a trade show in 2005.
Yeah. What were the rumblings of other content management systems out there? I mean, they were older ones, but why did these? It's just because of these two industry luminaries that just said.
That's part of what attracted us to them, but also the technology seemed solid. It seemed like the next generation. These things have generational cycles. You might argue that there's a new generation of composable technology now, which is displacing some of the leviathans of old. So we were at a point where we saw that the market was changing. We were looking for opportunity, and so they just kind of coincided with that. And the technology worked. That's the other thing. They were a company at that point that did what they said. The technology did what they said it did. They treated their partners very well, right? They didn't try to compete with us. We worked together to close deals, and so they're a really good partner. And we had lots of partnerships that didn't work, but this one did, and as a result, it became a large part of our business.
Yeah. Did they have, when you signed with them, did they already have a great deal of customer testimonials, big customers that said, their adoption rate was higher?
A great deal. I don't know. They were a European firm, and this was their North American expansion. So they certainly had European reference cases. They had a handful in North America, and they had a substantial pipeline. They did a good job of analyst relations early on, and so the founders are very clever in the way they came into North America and grew that firm. And so to a large extent, we benefited simply by supporting their growth by providing services to actually implement the product.
Yeah. When you say we, was that just you and your partner? How big were you at the time?
Oh, I'd have to go back and see. Probably around 2005. We'd been like 65 people, maybe at that point in time, doing a variety of things. And, as the internet evolved, obviously, in 1995, there really was no commercial internet. By 2017, there was, a thriving, half the world's economy depends on the internet. So what we did over the years changed. And as I sometimes say, if we'd been slightly smarter, we would have started like Facebook or Google or Amazon or something, but we weren't that smart. So instead, we had our own kind of a journey through this. But yeah, we evolved so that Sitecore became an increasingly big part of the business. But we did have groups that did user experience and marketing, and data and analytics, right? That was part of our offering. It's just that the real special sauce for us was the ability to work with this increasingly popular technology.
Yeah. I'm just curious, was there a gap in your company, or you just said, hey, we needed to resell and do value-added services for a content marketing system, or we're going to be missing out?
Yeah, like our general operating model wasn't even a strategy, but just the way we operated was we always tried to skate to the open ice. So when you saw a trend developing, we would try and get there so we could help our clients. So in this case, we knew that the infrastructure that existed did not support enterprise class websites. It was hard. There was like webmaster used to be a full-time job, and there'd be like dozens of sub-webmasters, and like people were doing things that computers did really well. And so there was a clear opportunity for technology to displace or change that model. Sitecore was a good solution to that problem, so we ran to that. But previous to this, we'd ran towards data and analytics at one point because we knew there wasn't enough information about how people were working, and we had a little spin-off that did that. We looked at the commerce opportunity, and so we had some commerce team members as well. So that was the idea, right? The internet back then was evolving so quickly that you kind of looked for white space and then made sure that you were able to deliver in that white space. Sometimes it didn't work out. Like sometimes these things just disappeared and they weren't real, but sometimes it turned into a whole market. And in the case of Sitecore, it did. So if I was going to rephrase it, and this is backwards looking, not the way we framed it at the time, but we kind of experimented, right? We tried a lot of things as the internet evolved, and we found out what people would pay us for. We did more of that stuff, and so we naturally evolved into a space.
Oh gosh, right? So, yeah, that's the feedback you got, huh?
Yeah. So it wasn't simple, like we weren't actively trying to find like a new partner in this space, but we found one. They were doing well. We thought we could sell it. We did. It worked out, and so we ended up in that place. If we ended up with a different partner, we probably would end up in a very different kind of company by 2017.
Yeah. And these were content management systems for Fortune 1000 size companies, right? Very large companies. Right. Yeah.
Yeah. Early on, they had a smaller set, like for smaller companies, but they got rid of that fairly quickly as they tried to go up market.
Yeah. And how much value added to your organization did that? You have the software, we install the content management system, and what's the value added service that comes with when you go to a Fortune 1000?
Yeah, so for something like a Sitecore or their competitors at the time, Adobe had a strong offering. There's a number out there. So at the sort of enterprise level, you weren't buying a product so much as the platform, right? Out of the box, the product doesn't
Yeah,
really
it's
do
not
anything
just
for
a
you.
box. It's just
No, this isn't like
yeah.
using Squarespace or something to stand up a website. Like it's basically a technology that lets you build on top of it. And so what our team got very good at was taking the vision of the client, understanding their business objectives, translating that into a design and content strategy and user experience that actually deliver that on those business objectives, and then embedding that in Sitecore so they could operate it on an ongoing basis. So that's really what we were doing, was taking the business vision and then embedding it in a system that allowed them to actually make that vision come true. And that was the story we told, and that's the value we added.
Yeah. Curious, how did that change the makeup of your business and your revenue, like shifting from whatever you were doing, and all of a sudden, Sitecore, you said, look, there's a number of that, but it just started taking off, and now you're kind of like a value-added reseller for Sitecore.
Yeah, we didn't make any. I don't think we actually resold the product very often. Maybe in Brazil, but not very often. It was more generally the services around it. But
Yeah.
I think what changed the company was that as Sitecore went up market to larger and larger enterprises, so did we. And so we had to learn how to sell into the Fortune 1000, how to actually do contract negotiations with very large organizations where it's not a handshake and they sign you a check, right? It changes the dynamics of how you market and how you operate. And the marketing piece is maybe where it became most important. So early on in the evolution of Sitecore, they had more work than they had partners. So they were bringing us leads, and that was great. We didn't really need our own sales channel. They were just bringing us opportunities.
Yeah. Can you go help this? Like they divvy up these leads, right? By
Yeah,
territory
or
or
we
so.
co-sell, right? Like it'd be like,
Yeah.
look, these people need, but they want the product to do this. Can you tell them it can do that? And we just, we were partnering in that. As they grew, that model had to shift. It does with any software company that's growing, so that they were, one, looking for larger partners, the Accentures of the world, right? And two, as they matured, there were simply not as many new leads showing up in their pipeline, and there's a lot more partners. So we had to establish our own marketing around Sitecore. And what we actually did, I can't tell you exactly the date, maybe 2010 or so, we sat back and said, okay, we're going to be known as the Sitecore experts. And so we used to close the company down for a half day every month, and everyone in the company would write content, whatever you know about Sitecore. I didn't really care. I mean, the HR manager, the finance person, I think the finance person actually carried pizza for everyone else who was writing. But basically, we produced thousands and thousands of articles on Sitecore, on virtually every topic to do with Sitecore. And it really worked because these were people who were wrestling with the challenges of implementation on a daily basis. And so they had answers to really hard questions. And they would write 500 words. We'd publish it on our website, which grew very quickly. Not all the content was about Sitecore, but a great deal of it was. And we packaged up the most popular articles into a book, which we used to ship to prospective clients. And we built basically a content-driven marketing engine so that by the time we sold, that was part of why we were attractive to Valtech. We were one of the, if you search for Sitecore and two other words, we would show up no matter what you were searching for.
You were
inbound
so much content marketing kings.
Yeah. It was killing it, right? And that's a great flywheel once it's running. It takes a long time to get there. It takes a lot of investment. And if you do the math on what it costs to shut down the company for a half day of billable time every month, it wasn't insubstantial investment. But once that's live, we were having, if you were in the market for a Sitecore implementation firm, our name was almost always in the conversation.
That's fantastic. First page on Google. Yeah.
Yeah, it really made a huge difference. And it was a big bet for us, but we believed in the expertise of our team. And we believed that by sharing that, we could fairly clearly, carve out a space and a name for ourselves. And that certainly helped. It helped us operate the company. And then it helped us drive attention from prospective acquirers.
Yeah. What was your, before you had this strategy, after you had this strategy, inbound content marketing, SEO, what was your, do you remember what your revenue and employees were to what your revenue right around,
I'd have to go back and check. We did some of this too, and there's external factors. We had a large office in Calgary, Canada, which is an oil and gas capital. So when oil and gas prices plunged, that hit us pretty hard because it changed the kind of clients that we had, right? So things like that happened, right? 2008 happened. So it's hard to tie the two exactly together. I can tell you that traffic to our website and inbound lead flow went up thousands of percent from where it had been. And we were able to pull back on our direct sales team. So fewer direct salespeople, more inbound leads, more subject matter experts doing the selling. Our close rate went up. Basically, it was goodness all around. It just took us, 2.5 years of investment to get there.
Yeah, traffic and conversions. That's fantastic. And then you got this, received this offer from Valtech. Were you actively putting on your business on the market with you and your partner, or?
Yeah, we Shannon and I sat down after 23 years. It wasn't just the two of us. Some of the senior management, Alison Abraham, Danielle Roberge, both had. They were key people, and we planned on ensuring that when we sold the company, they benefited as well. So they were part of the decision-making process, and the company itself had a profit-sharing scheme. So it was a broader set of decision makers than just Shannon and I. But we did decide in 2016 that it was time for us to investigate the market. Sitecore had been growing very rapidly. We knew from experience that wasn't going to last forever. We also knew that the windows for selling your firm open and close over time. So there was a window around the dot-com boom where you could have sold the company for ridiculous dollars, although it's hard to know if the company would have gone bankrupt immediately afterwards and not paid those dollars because the crash was very quick. But there's a window there. The window closed after the dot-com boom. The window opened up again before 2008 and then closed with the financial crisis. It opened up again about 2010. And I argue that right now it's harder to sell your company than it was maybe a year ago, given where interest rates are at. So we had this knowledge that there are times that are good to sell and times when it's harder to sell. We thought, okay, we don't want to wait one more business cycle. This is probably our time to go to market. Our financials were good. Sitecore was growing quickly. That meant that our market was growing quickly and we were more attractive than we might have been if we were working with an older technology. We thought that our international delivery model made a lot of sense. And so we hired a banker and we formally went to market. I think we talked to 82, 84 companies, something like that, over the course of a year. Some of those were private equity.
82 different bankers, investment bankers?
Yeah. Well, so no, we had one banker. We were talking to potential acquirers and potential investors. So our banker took us out, and we didn't spend enough time actually choosing our banker. It worked out, but I wouldn't recommend that. Like, I would now spend as much time interviewing your banker as you do, going to market, because it's a critical decision. We got lucky. It was not due to good judgment.
Yeah.
But we did this roadshow basically for 12 months. And the great advantage we had is that Shannon, Dan, and Ali could run the company. Well, I went and did the roadshow. So we kind of split responsibilities and we didn't distract ourselves from the operational execution. And I think it's really critical because now that I'm on the other side and we're acquiring firms, I can tell you that it's very easy for founders to get excited about selling the company. And while they're doing that, take their eye off the ball of running the company. And if your financials go like this, it becomes much harder to sell the company. So we were able to solve that by kind of like putting a wall between the work I was doing, trying to sell the company, and the work they were doing, trying to grow the company. So you can't always do it if you haven't got the right team, but in our case, it worked out really well.
Did you have the insight to know this, or did the M&A advisor tell you to do this? Like, you need to have some walls between, the pitch in the business and still running the business.
Yeah, it wasn't our advisor that gave us that information. It was sort of a mentor that we had historically that suggested it. And he'd been more involved in selling technology product companies, but nonetheless, it was very good advice. And
we took it. Fantastic advice. Yeah.
Well, we were well equipped, right? If you don't have two founders, if you don't, sometimes you just can't do it. You don't have the people, but we did have. It meant that everybody had to pick up more work because I suddenly wasn't selling. So Shannon had to, sell more, and I wasn't, I was still doing some CFO duties, but Shannon had to lean into that more, or maybe Dan did. So it was not easy, but it was easier than it would have been having one person trying to do both, which I think is a really difficult thing to pull off.
Yeah. What about other parts of the business? Did you and Shannon talk about, hey, we need to be at this profitability? Can we boost it up a little bit, or get more revenue per employee, or longer term contracts with customers? How did you model that? And
again, I wouldn't, if it was to do it over again, we probably would have spent more time trying to tweak those variables, right?
Yeah.
But instead, and partly because of the way we did this, they were running the company as if we weren't going to be sold. So they were still making long-term investments that wouldn't pay off within the time frame of our sale, which is not generally what you do if you're trying to sell the company, right? So we didn't really fine-tune it for sale. We just kept running the company as it's run, right? So our numbers are pretty good to begin with. So that was partly why it was advantageous for us. But now that I'm see it from the other side, certainly lots of companies will spend 2 or 3 years just refining their firm so that they maximize the value as an asset for the 6 to 12 months when they're trying to sell the firm. So we didn't do that, but I think we were pretty solid anyways in our financials, and we were in such a growing market that I think the market demand as much as anything else is what enabled us to take it to market and sell it.
Yeah. So you you did 82 pitches.
Yeah, roughly. Now,
Yeah.
some of those were to raise. So we ran two paths at once. One was to sell the company. One was to raise money, say private equity, and do a roll up or that kind of thing. And we realized pretty early on that that wasn't going to give us what we needed. It wasn't the model we wanted to pursue. So maybe half of those were private equity firms that we set aside. The other ones were potential acquirers of various sorts. And most conversations ended pretty quickly. Some went a bit further. Some culturally, it was really clear we were not a good fit very quickly. And some really struggled with things like our Brazilian operation because Brazilian legal principles are different than North American legal principles. How can I put this? If you're a firm that only does work in Ohio and you're like, a $1 billion firm, the idea of Canadian law is scary, let alone Brazilian law. So there were certain firms that just didn't feel comfortable
Yeah,
with our sort of mini multinational status.
it's like difficult to become an expert at the law, and like even in the UK, if you don't have a footprint in the UK.
And
Yeah.
it's so it was funny because for some firms it was an immediate barrier. And really, I got to the point that I would just raise that in the first call, like the first 10 minutes of the call, because if it was going to kill the conversation, you wanted to kill them quickly rather than investing time. And lots of firms just couldn't figure out how to do that, or weren't interested in having a multinational footprint. But then for somebody like Valtech, it was a very different experience. The main person on their global M&A team actually had a cottage fairly close to our office in Florianopolis, Brazil, as life would have it. He was Argentinian, like he knew the space. It was a very different experience with them. They were already a European firm, small North American presence. They operated multinationally. They kind of understood transfer pricing and all the things we were doing. So it was a very simple conversation with them compared to what we'd had with many other potential acquirers.
Yeah. Were they already on the list, with the original list of
No,
potential
not even
acquirers?
close. Had never heard of them. So this is where our banker did his job because he brought them to the table. We had never seen them in the market, never heard about them in conversation, never run across them at a trade show. And I would have sworn to you that I knew every potential acquirer out there. And this just wasn't the truth. Now, the reason why is because while they were a fairly large organization, they were large in Europe. They were not large in the Americas. They only had about 100 people, maybe 150 in North America when they acquired us. So we essentially doubled their North American or their Americas operations when they acquired our firm. So they were small enough that we'd never seen them, but they were large enough globally that we were a really interesting addition for them. And that combination was really attractive to us because it meant that we were able to join a firm where our people had a chance to thrive because they were stepping into a quickly growing North American operation that was roughly the same size. And so they all rose to their level of capability and many of our people have become like critical components of Valtech post-acquisition.
Yeah, so to them, it felt like it was just a perfect puzzle piece that they were missing.
Yeah, I think so. Like they had I can't really speak on why they purchased us because obviously they want to hide their motivations. And what I didn't know at the time
Not to
was
get
that
too excited because we're going to be overpay for this.
right. They had a very large Sitecore opportunity in front of them in their sales pipeline, which we didn't know, but we helped solve that problem. We gave them scale in the Americas, which they needed, and we gave them access to some great talent. In fact, if I step back, one of the reasons that Shannon and I thought it was the right time to sell the company is that we had a whole bunch of people who've been with us for a really long time. 20 years, 18 years, 16 years. These are really good, solid, smart people, ambitious, but we were the cap on their ambitions because we couldn't grow the company fast enough to give them career paths. And our sense was they were going to have to leave the organization to really become what they could be. And we thought, well, if we find the right partner, then maybe they can stay with us. We can still continue working together and they can sort of rise to their level of capabilities. And so Valtech was a perfect partner from that perspective because many of them have gone on to be like managing directors of a $72 million operation within Valtech.
Yeah. How did you know that? Do you have like the 360 interviews with the employees to find out where they want to go, or we sensed it, or did somebody say, hey, I think we're going to lose them? Yeah.
So a couple things. We lost a couple, right? Which tells you. And so we did exit interviews, and they're basically, I've loved my time here, but I need to, I want a different career opportunity than what I can see here. And I get that. Like my job wasn't available. So, there was a cap to how high they could climb in the organization. The other thing we did is because we had these long-standing team members that, if you work with somebody for 16 years, there's much, I won't say family, but there's a friendship and there's certainly a collegiality that isn't there in some boss-employee relationship. So the lines of communication were really clear in our organization. People felt comfortable coming to us and saying, like, in 3 years, just so you know, I'm thinking about moving on because I want to do this in my career. So it was partly just a transparency inside the organization. It's partly some exits, and partly just our awareness that it'd be time to do employee reviews, and we had nothing to tell them about where their career could go.
Where they're going? Where are we going with the company?
We just can't. We can't double the company by next year, so we can't build a new. I can change your title, just not going to change the job at all, right?
Yeah. I'm going to get an office with a window. Yeah.
Yeah, right. So it was more awareness that way. Like I wouldn't say it was like some sort of like programmatic thing that came out. It's the fact that we knew our team and we were really aware of that we were sometimes the constraint on their ability to be successful.
Yeah. Did the M&A advisor or you, when you got down to Valtech, did you have a couple offers on the table, or were they the only one?
By the time we got to Valtech, so we went down the road with a couple of opportunities that didn't work out. Sometimes on their side, sometimes on ours. We didn't get into detailed due diligence with anyone. We kind of killed the deals before then. But Valtech, they were the only person we pursued at that time. So it wasn't an auction situation.
Yeah. It's like, and I know the M&A advisor playing Valtech against somebody else possibly in the market.
Well, certainly to get to the letter of intent stage, right? It was clear there was other offers out there. But it wasn't, we weren't doing a pure auction where it's kind of like, write down your best offer on a piece of paper and slide it across the table kind of thing, right? We got to the point that Valtech had made us what we considered to be notionally a very fair offer. And more importantly, we like the structure of the offer, right? The dollar value doesn't matter nearly as much as how you get it and when you get it and what your certainty is of getting it. And we felt that the cultural fit was very strong with Valtech, both for our people and because we wanted to stick around. We thought we wanted to spend a couple of years just seeing what it was like to be part of a larger organization. And frankly, we've all stayed around. The whole senior team is still at Valtech 5-6 years later. So that part, we checked the box, right? We found the right place for our team to succeed.
Yeah, so that was one data point. What else made you feel confident that they would give you the terms? Like, let's say it was a larger offer, and will they pay you over these terms? What else made you feel confident that?
Sure, it's a good question. Yeah. So let me just put on my other hat now because I do acquisitions for Valtech at this stage, right? And
something we're going to talk about that. Yeah,
maybe I'll put on a third hat, which is just what I do when I'm talking to other entrepreneurs. That's even maybe more useful. So people get really excited by the dollar value in the letter of intent or the non-binding offer or whatever it is. So say that the dollar value is makeup number. It's $3 million. Well, if that $3 million is 10% cash up front and the rest is an earnout over 5 years based on your performance, and you have the ability to do much better than what's in the deal, you really don't know how much you're going to end up with. And in many cases, you're not going to end up with anything like that original offer. Right after, the only dollars you can count on is what you get at closing, unless you put in structure a place that is different. And Valtech has been pretty good about using earnouts not as a way of reducing their risk, but as a way of aligning motivations. And so what they'll say is, yes, 20% or so, maybe more, will be an earnout, but it's short. 6 months, 18 months, somewhere in there. It's designed to make sure that we all believe we can succeed in this.
Shorter, 6 months.
Yeah.
Oh, interesting.
6, 18. Yeah. So for a very different reason. The idea is like you have to believe you can exceed. You have to believe that this whole thesis for putting the two firms together makes sense for you too. And so one portion is that short earnout piece. Another thing that Valtech commonly does is that some portion of the deal will be in stock in Valtech. So you acquire stock in a private company, Valtech. Once you've sold, you have to believe that stock is going to be worth more in the future than it is today because you'll have to hold it until there's a liquidity event at some point in the future. So again, that's about aligning interests going forward. That's a deal structure that I think is really attractive to founders. So in many cases, we've seen when we're acquiring firms, we see that they may take a lower dollar value, total valuation, based on a structure that gives them much more likelihood of actually achieving the dollar value that's agreed upon. So all that to say, when you're working with your banker, and if you don't use a banker, make sure you've got somebody who's done this before and understands it. The details of the deal really, really matter, at least as much as the headline number that you see when the email comes in.
Yeah. Did he have a possible valuation for your company, or did you guys put the valuation together and say, okay, Valtech's in there, right? Within 10%.
Yeah, and let me tell you how we went about that. It's hard in the world of technology, especially. Your company is worth exactly what somebody will pay for it, and that's how you know how much it's worth, right? So during the dot-com boom, it's ridiculous ratios. If you were a crypto company, you had ridiculous valuations a few years ago. I think right now, if you had a generative AI consulting firm, you can probably ask for numbers that have nothing to do with your financial reality.
How are those NFTs doing for you?
Yeah, right. Yeah. Right. But outside of those moments, there has to be some financial rationality in the sale of a company. So if you're a services company, as we were, we knew that the range is like, I don't know, 0.8 to 1.2 times revenue, maybe 1.3 times revenue, or the equivalent for EBITDA, which is like, I'd have to go back and look at that time, but maybe somewhere between 6 and 12 times EBITDA is what you were likely to get in the marketplace. And we were aware that those numbers, they just kind of make financial sense on both sides. So there's that piece, right? Like we knew it's going to be somewhere in there. Yeah. From another perspective, Shan and I sat down and said, like, how much do we have to get for this thing to make it worth our while, right? For us to take the next step. And so we had some bottom, walk away numbers. And then it was a question of testing the market. And so when the letter of intents come in, you see kind of where in that financially viable range the offers came in. And Valtech was, it wasn't the highest number we'd seen, but it was a certainly within our set of expectations. And more importantly, it was structured in a way that we believed that we could succeed with them.
Yeah. Did you have, just curious personally, did you have an arbitrary number, like the threshold? People say, I want $1 million for it or $10 million for it versus, I'm going to get, 4.367. I'm happy with that. No, I needed it to be 5. So you need to raise the overall offer. Yeah.
Well, we did have a walkaway number in our heads, right? So it wasn't, so I've run across this, right? People think their company is worth far more than it is sometimes.
Always.
Just based on the realities of the market.
I've never heard anybody say it's worth less. So
yeah. So like, and it's, you'll see these public deals for SaaS, software as a service companies, SaaS companies, and they're selling for 70 times earnings or something like that, right? Which is madness.
Yeah, and 14 times sales. Like, okay. I mean, I'm not going to put any debt on this because it doesn't make any sense. But
so you have to realize what you are when you're selling the firm. So we looked at it this way. We looked at, okay, so how much cash would we be able to take out of the company over the next 7 years if we keep running it the way it is with some assumptions about growth rates and that kind of thing. Okay, that's roughly what the company is worth to us in dollars and cash value. So we knew that. And then we thought, okay, what's the equity worth? And we came up with some number that kind of made sense in our head. And that wasn't so much for negotiation purposes with external parties. It was so that we had alignment among Shannon and I to make sure that my business partner and I, we owned half the company roughly, that we both have the same number in mind when we were having the negotiations. So that was really an internal conversation we had, not one really meant for external negotiation.
Yeah. When you say you own half the company, is that 50% of the company or he,
you
so 50 and
we
he
were
50?
Structured, we were structured 40% I owned through a holding company, 40% he owned through a holding company, 20% was an employee trust that held shares on behalf of the team. And that structure actually really worked for us. It's not one that works for everyone, but it can be tax efficient. But it does put the trust in the word trust because everyone involved has to be pretty confident in the trustees and the other players. So worked for us. It's an interesting structure that I have advised other founders to take a look at. It's cheaper than doing employee share option plans or an ESOP, and it just has some advantages. I'd have to look at the U.S. law to understand how the tax implications are in the U.S., but in Canada, it worked out pretty well for us.
Yeah. So did Valtech purchases you? What was your intention, you and Shannon's intention to stay with the company? It's a much bigger company, or take your money and go do something else?
It's an interesting question, right? So there's what we told potential acquirers and there's what we actually felt in our hearts. And I think those were aligned, but it's sometimes hard to know. Like we both knew this, the biggest companies we'd ever built were companies we'd started. So, as an aside, we spun off this technology that looked a lot like Google Analytics back in 1999 or something, raised a bunch of money from a venture capital firm in the US, blew up gloriously the .com debacle. So that was about we got to about 200 people in that company. So I said, like, the biggest companies we've ever been involved with were ones that we were inventing from scratch. And it struck us that maybe other people who'd built large companies could teach us something. So it wouldn't be a bad idea to hang out with a fast growing large firm. And so when Valtech came to the table and we saw kind of their growth rate and the expertise they had in their senior team and some of the really astonishingly talented people they had, particularly in Europe, we thought, okay, there's a lot we can learn here. So let's see if they can use our talents for the next couple of years. They may not want us. Lots of firms don't want the founders to stick around because we are kind of a pain in the ass, right? At the end of the day, because we're all still pretty sure we're in charge.
Yeah, right.
Yeah. Oh, and we're pretty sure we're in charge, right? So when you've got a company that's bought a bunch of founder-led companies and keeps the founders around, like the management meetings are chaos. We're all pretty sure we're the person in charge, but we're still.
How would you have to be the individual you have to be to manage people like the Los Angeles Lakers? All big, 11 people on the team. They're all making multi-million dollars. And like, who do you have to be able to tell that guy to do something?
That's a good point. Yeah, I'm not sure we were in Lakers territory, but one of the advantages, and this is really not something I would have predicted, but when you've got a company that's built at least partially on founders who've grown their own companies and had an exit, a lot of the politics goes out of it because nobody's kind of trying to build a career within Valtech. Nobody's doing trying to build their own empire because we kind of did that already. So now it's more about doing this new thing together. So some of that internal dog eat dog politics kind of goes away, which is a really nice advantage that Valtech has compared to some of the other large global systems integrators or agencies. And I think we've certainly had people join us from very large organizations because they appreciated the lack of politics within the walls of Valtech.
Who was it that asked you? Do you want to stay on? Do you want to take a new role in Valtech? Was that It
was their global M&A lead who sort of said, here's how we perceive it afterwards. In fact, Valtech only buys companies if the founders state they're going to stick around. They don't always because you can't actually sign them into
How long did they ask you to stick around, minimum?
That's an interesting question. So again, it's an ask. Certainly through the earnout period, but that might be 6 to 18 months. I'm trying to think of we've had one that exited at 6 months. Most have stuck around for at least a couple of years. Some the firms were purchased before mine. Those folks are still around. So most for longer term.
They like working at Valtech, obviously.
And they like working together. And, it's not very often you get to see a company that's growing at this speed, at this size, trying to, do some world changing things. It's a pretty big educational opportunity.
Yeah. And so you come on board, you join their M&A team to turn around, take your skills and go look for acquisitions to help Valtech grow. So do you feel like I know exactly what to look for in the next in an acquisition? How to make what is a content management system, digital marketing company? What does an irresistible offer look like?
Everything's more complicated than it sounds, right? So I didn't go directly from joining Valtech to being involved in the M&A team. It sort of evolved as I was able to identify some companies I thought would be good choices for us, right? And suddenly it became a job. And my job is really to pipeline development, right? Find firms that I think are good fits and then have conversations with founders because I can do that because I've been one. It's an easy conversation to have. But I don't negotiate the deals, right? That's done by the global team. I will help frame the business conversation or the business logic for the deal in a way that we're able to present it to the board. But I'm not really involved in the nitty gritty of figuring out share transfers.
Here's your valuation. Here's how you're going to get the price terms deal.
I don't need to do legal due diligence. I do that once from my side. I don't want to do it from the acquirer's side. It's a difficult and fine
Did it
thing.
once. That's enough. Yeah.
Yeah. So I do feel very comfortable that at this stage, we know which kind of firms will make Valtech for the company we want to be, right? Based on our 5-year plan. And it tends to be a firm has to solve, either let us take advantage of an opportunity or solve a problem for us. So I'll give you an example. We're very strong in healthcare in Europe as a market, but in North America as a vertical, in the US as a vertical, we really didn't have much traction. So when a firm came on market that we knew, we liked, and they were really strong in healthcare, that was a pretty big feather for us, right? That's something that was very attractive for us, was giving us a foothold in the healthcare market.
That is a growing market. That's never going to stop. It's just a huge multi-billion, trillion-dollar industry. Yeah.
And there's a situation where the vertical they were in is what gave them, I think, certainly caught our attention, right? And gave us a business logic for the acquisition beyond just the financials. It might be a situation where we do something in one part of the world and we want to do it everywhere. So an example there would be we have a very large joint venture with Audi where we're helping design the software for the next generation of vehicles. And we don't do any of that work in North America, right? We were doing it basically in Germany. And so when we found the opportunity to acquire a very small company in Detroit to get a foothold in that space in North America, well, that was very attractive to us because it was a matter for us fitting one of our needs that we've already solved it globally, but not geographically in North America. So again, that was a really attractive piece.
Yeah.
Partly about the vertical, partly about the capability. And then sometimes it's about scale, right? We're a global provider of commerce services. We help some of the largest brands in the world sell online. That's a growing space, and it's hard for us to hire fast enough to meet the demand. If we can find a firm that has a lot of people who really understand the space, that's really attractive to us.
Yeah. What kind of companies are you referring to there?
Well, so there's all sorts of, I don't want to name names, but well, sure. We acquired Absolunet out of Montreal, Canada, about a year and a half ago. They had about 300 people, if my memory serves, who were helping implement Adobe Commerce and Magento for mid-market companies. So they were experts in doing that. They could help companies stand up commerce sites very quickly, reliably, make them work, help them actually sell effectively online. Really good company. And that just helped us deepen our existing group, which is already doing those kind of services on different platforms. So it's just about adding more to what we do and giving us a scale that we didn't have previously. So there's an example where it's not new. Yeah, it's not new. It's just more of what we did and broadening the partnership strategy. So it's kind of like if you want to be valuable to an acquirer, being really strong in one vertical is one mechanism, or finding a fit where you let them round out their offerings from a global perspective can make you valuable, or just adding scale in what they already do. But then you need to be bigger for it to be something where you're going to drive better valuation.
Now, where does that mandate come from? That like the board meetings or your group meetings and say, hey, we don't have this piece of the puzzle. We need you to go find something to do that because we want, they're coming back. Oh, we need to grow 50% per year, right? Oh my God, that's an insatiable appetite. Who do we need to go?
Yeah, there's a top down and bottom up aspect to this, honestly. So there's, and this, because it's rapidly growing, that's not surprising. So certainly there's a defined strategy for the company, what we want to be when we grow up. And we have a fairly good understanding where we're lagging in that vision or where we have gaps that we have to fill. So that's kind of the top-down piece of it, right? And we'll say, okay, like this is the thing we need. Then there's the bottom-up, which is that there's emerging technologies that maybe surprise us. The rise of composable, we made a heavy bet on that, but 5 years ago, nobody was talking about that. We have a group that's doing generative AI services. Well, 1 year ago, that wasn't in our roadmap, but that's kind of evolved from the market, right? And so then we're being kind of market sensing and identifying firms or people that can help us. So those are the two mechanisms.
I was watching a conversation. I don't remember who it was. It's not today only looking at companies that are developing revenue and they own their market. You still have to look at these kids that are developing technology that can really replace these other companies very fast.
Yeah, I think stepping aside from the M&A question, I think what's happening with generative AI right now has the potential to be one of those like super seismic shifts in the economy, like the internet was, where it just kind of touches everything in the economy. Not like one, it kind of becomes a platform the economy operates on, kind of the way the internet did. Like I didn't feel that way about cryptocurrency, but this feels like there's something very real there. I don't know how to play out, but I do think that's a space that's going to change how we operate the economy, and there'll be lots of opportunities for startups in that space. And we don't know what those are yet, because I can guarantee you in 1995, nobody thought that TikTok would be a thing.
Now, watch kids dancing for 90 seconds. Yeah. Who thought like Mr. Beast? Do you know Mr. Beast's last 4 videos did 188 million views, which is bigger than all of the major mainstream channels to combined.
It's almost unthinkable.
Yeah.
It's amazing, right? Like not something that would have been predictable. So you wouldn't have predicted that an individual would be dominating that market if you went back in time. You might think, okay, probably the mainstream organizations will get into this and dominate on YouTube the same way that they always have historically or something, right? But that's not what happened. You did have Netflix arise and then Prime and the streaming services, which is kind of where that went. But yeah, I think it's very hard to predict. There's nothing linear about how these big seismic changes happen in the economy. It's like opportunity erupts, people take advantage of it, and it finds new homes in the economy that you really wouldn't have expected. The classic example is that when people invented the car, no one would have predicted drive-in movies. I'm dating myself with that, but it's true, right? There's nothing obvious about we have cars. Well, now we all want to go drive and sit in the field and watch a movie play on the screen. Why does that make any sense, right? Nobody would predict that, but at one point it was a huge industry. I think something similar is happening, will happen with generative AI, that 5 years from now, there'll be all kinds of companies that right now we can't predict, which retroactively look obvious, right? That's the kind of way these things evolve.
Yeah. How do you stay young to look for that? Like, we, as we get older, that we do get our biases and just age, and we just don't see stuff that is coming up. And like that, I had this conversation on LinkedIn with somebody. I said, well, I watch my kids. Like, they can sit there and look at 60-second videos and just scroll and waste 2 hours of their time just looking at 60-second videos.
That is a true statement. It makes me feel very old. I know I'm feeling old. I feel like I like raising my hand and go do something worthwhile with your life, kids. Which means I'm old. There's only so many cat videos in the world. They're not helping you.
Yeah, like it's funny dogs. Okay, yeah, thanks.
Yeah,
Jack.
so like,
yeah.
and I can get sucked into it too. So I'm not immune to it, but I'm not sure it's productivity enhancing or life enhancing for most people. I don't know.
No.
How do you stay young around this, or move away from your biases? I think it's really hard. I think one area that I find fascinating is to kind of watch where the early seed money's flowing, where venture capital goes. It gives you some sense of what bets are being laid by people who spend their whole life thinking about this, and that'll give you some sense of what's interesting. But if you're not passionate about it, you're not going to pay attention. And we talk about entrepreneurs. The vast majority of entrepreneurs aren't tech entrepreneurs, right? This is a very peculiar orientation we have, where the myth of Silicon Valley makes us feel like, if you're not doing a WhatsApp startup, you're not an entrepreneur. Well, you know what? There's lots of people who've built a chain of car washes that are making $200 million a year, and their kids will run that, and their grandkids will run it. That's the real economy. And in many ways,
Mr.
they're
Beast
the
is
more
from North Carolina, right?
Right? Like, honestly, I think that's, when you step away from the technology world, there's still, how many people are running mom and pop restaurants out there, or a small chain, 6 or 12 hubs in a region of the country. Like, that's really the real economy. And we forget that sometimes when you start talking about the technology world where things change so quickly, because I don't care how many cat videos you watch, there's still going to be a market for people to go out and have a pint once in a while.
That's true. So true. Let me ask you about when you get this assignment downhill that says, hey, you need to go find this. What do you look for in an irresistible company? I mean, there's characteristics, the first is the financials, the business model, kind of the process, that area. What do you look for?
Yeah.
It's
Absolutely. So financials are important, right? We're looking for growth. We're looking for profitability. We certainly don't want to buy a firm that's growing slower than we are, or which is less profitable than we are, because it kind of brings down our averages, right? There are exceptions. If it's truly strategic, we might make an exception. But generally speaking, we want to buy firms that are growing as fast as we are, and who have EBITDA growth as fast as we are.
What's as fast as we are? Are we talking about 50% a year, or 500% a year?
So the general rule in the market, not just for Valtech, is that you're looking for some combination that adds up to 40. So you want to be growing at 20% a year at 20% EBITDA. That's great. If you're growing at 40% per year and you're not making any money, that's okay, right? So as long as EBITDA plus growth rate, those percentages add up to 40, you're probably in the right ballpark. That's really hard to do, by the way. Like, there's not many firms that can pull it off, but that's what we're aspiring to. Not everything reaches that number, but that gives you some guidance of where you'll get the highest valuation. But financials aside, because if you assume the company is being run, then what we're really looking at are
let me ask you about the financials. Interrupt you on that. Sorry. When you say, like, it needs to be they say, hey, what's the revenue per employee? Like, in SaaS, it's going to be a lot higher than an HVAC company or something like that. Yeah.
So revenue per employee is an important metric, but it's when you're looking at global companies, it can get really skewed. So that's the caveat on our part. So, I've been talking to a firm recently that has operations in Latin America. I think it's Colombia, Brazil, a group in India, and then a team in North America. And because they're in those other countries, they have a lot of employees. Like the Indian component is gigantic. And so if you just do the simple math, revenue by employee, it looks really small because they've got a whole bunch of low paid. So like it's not always the most useful guide. Like, Warren Buffett was right. At the end of the day, it's cash flow. Are they spinning off cash or not? Think hard about how you're doing that, because EBITDA is always subject to adjustments, which can be hard to understand from the outside. But cash flow is something that any acquirer can look at and understand. Are you generating cash? And I would encourage companies to optimize that if they're thinking about going to market, because it's a really important indicator.
Optimize your cash flow before you grow big. Yeah.
Yep.
That's a good rule.
And then it's about part of it's about transparency, because especially in a services business, you're buying things which cannot easily be seen, right? You're not buying a factory filled with machinery. You're buying people that are able to have processes to produce probably electronic goods, right? Data-based goods for people. So it's hard to see what you have. So I'd encourage firms to think hard about making transparent how they operate. If you have a formal operating system, there's you might hear about EOS or Traction. There's a few of them out there that are actually sort of like operating systems have been defined.
Right.
It's less important that you've got a label on them, but more importantly that they're easily understandable from somebody who walks in.
The idea from here to the raw goods to this, and these are the people that run it, and these are the costs, and this is the process to turn assets into cash flow.
Yeah, and then decision-making cycles. So how do you make decisions, right? It's we have a Monday meeting on this, we have a quarterly meeting with our board on this. Like, just have that documented so you can see fairly quickly how the company actually operates. All companies operate. If you're making a profit, you're doing something, right? But often it's not documented, and it's really hard to piece that together, the mental model together, if the firm hasn't crystallized it for you. So that's something that bankers don't often talk about, but it's really important from the acquirer's perspective. It's just giving transparency to how you operate so that the acquiring firm can have some confidence.
In turn, or the opposite, we were looking at a engineering firm, or it's a manufacturing firm, but it's run by an engineer who there's no process, right? He has a great idea. He goes, hey, you should go do this CNC thing. And then it comes out the other end. And sometimes it's a hit and sometimes it's not. There's no process to that. How do we value that? Because if he steps out of it, it's gone.
I probably should have started with, if you are instrumental to the running of your company, you will not get the valuation that you would if you can go on vacation for 3 weeks and not answer the phone.
Right.
So, you have to extract yourself from the key roles in the organization, or your company is really hard to sell. The firms we buy are usually of a size where that's happened, or else you've got somebody it's pretty hard for one person to be instrumental in every process. If a firm's at $15 million in revenue in a services company, they have to have a gigantic brain and more than 24 hours a day, right? Because you can't do that.
Yeah, if Elon Musk left, can you run SpaceX, Tesla? I think you can run Tesla now. I don't know if you can run SpaceX though.
Elon's a very special guy. I think it's fair to say that from a whole bunch of perspectives.
They just sold some stock for SpaceX, which boosted his net worth by $50 billion in just a short period of time.
I don't know, anyone who can look at the world and decide that they're going to compete with NASA strikes me as having he just aspires at a different level than I'm comfortable with. So it's astonishing what he's done. Any of his personal
I'm just going to launch 50 satellites. We did that yesterday. Yeah,
it's madness. So yes, he's an example where one person with a gigantic throbbing brain was able to do everything in multiple billion-dollar companies. But unless you're him,
there's a lot. There's 1 out of 8 billion people on the planet, right?
Yeah, you might think about stepping away and letting people. The other thing is, it turns you into a better company. It gives you a better lifestyle. There's a whole bunch of reasons to do it, even if you're not selling the company. The most important one is you get your life back. You don't have to spend 14 hours a day in the office, right? So I would encourage that. It's not easy, but I would strongly encourage founders to find a way to hand off their most important roles and do it kind of prescriptively. Like these are the things I do. By next year, I'm going to be doing half of these, and the year after that, I'll be doing half of that. It's a useful way of thinking about your job, growing out of it.
Where do you put a score or value on the business model of an acquisition?
Really good question, right? Because and Valtech's a little bit unusual in that we're buying services companies, but a general rule, and even for us, the certainty of the revenue going forward is a really important indicator of whether or not we can get a deal done. So if you're a company, and there's multiple ways of looking at that. So in some cases, you may have long-term retainer contracts, so it really is guaranteed. So that's like maybe the A+ level, right? Those are rare in service industries, but not unheard of, right? They do exist. Or you might have something like a agency of record deal with a large organization. So it's not that that's guaranteed. It can be canceled, but probably they're going to continue working with you. And so that certainty of revenue increases. And then underlying all of that, and I probably should have started with this, is that if you need to be able to demonstrate how someone goes from not knowing you exist to signing a contract. And that process has to be something which is replicable and ideally scalable. So if you have a model where you can say, yeah, just pour money in this side and, we get deals out this side and it happens at this ratio and, this is what we're doing. And if you just put more money in it, you'll get more. That goes an awful long way to reassuring the acquirer that what you have is a real company that can scale beyond the relationships of the founder and a handful of salespeople. You've got something that can generate long-term revenue certainty that doesn't rely on the personalities of a handful of people. Yeah. Does that make sense?
Oh yeah. If I give you $1 and you could turn it into $5, tell me how you do that. Like, what's the process there? And can somebody repeat that if I train them, right?
Yeah, and that's the critical piece, right? It can't just be because, I went to Harvard and I know half the Fortune 1000 CEOs. Well, that's great, but if you leave the company, then we lose all the value. It has to be like, what is your go-to-market strategy? How's it executed? Again, you have one if you're making money as a company, document that, crystallize it, put it in a form that's easy to understand, ideally get numbers on it, like do the work to get the analytics so you can show them how it works, because that just changes the conversation immediately.
Yeah. Oh, I get 100% of my leads from referrals. How do I do that?
Yeah, that's hard. That's hard. Again, you have to document it somehow or show us or something.
Yeah. How do you score competitiveness of like where they rank? And
that's interesting. Probably rather than scoring it, it probably comes out of the growth rate of the company. Right? If you're more competitive, you're growing faster at higher EBITDA. So it kind of naturally comes out of the financials. I don't think we sit down and say, okay, like here's a T-graph of, how they compare to the competitors. That's not how we usually do that.
Like here's one measure. It shows up higher on Google SEO. Okay. Yeah. Right. You're competing against each other.
Yeah, sort of. And it's more like, it's also really when you're acquiring a company, it's not really about all the companies in the space. It's like comparing you to the other ones that are for sale right now that solve our problem. Right. Yes. So you may not be the best in your space, but you're the one that's available and you're the one that's, for sale at this point in time. So you may love that house in the corner. It's the best house you've always wanted, but if it's never for sale, you can't get it. So you buy the house next door. Right.
Yeah. Unless you're
so it's about the available market.
Costa Nostra.
Right. Yeah. Something like that.
I want this house. Okay.
Yeah.
What about how do you value customer concentration and in how you
small companies, that's a killer. It's just a killer. Like if you've got 50% of your revenue tied up in one customer, it's really hard for an acquirer to buy you. No matter how good it is, no matter how long the relationship is, because it feels like, we can pay X for you. And if they have a change in leadership, we could lose 50% of the value of what we paid overnight. It's a really difficult, and we see this all the time because like from the entrepreneur's perspective, what, you're going to say no to more work from the existing customer? Well, of course not. You're going to take the work.
Right.
It's really hard it's really hard to get past that because you have to find some way that if you've got one customer that's more than 30% of your revenue or 5 that are 80% of your revenue, you need to find a way to build a new business engine that lets you grow that percentage down as you grow the company, because otherwise it becomes really difficult for an acquirer to make the logic work for the deal.
Yeah, let's say your marker is 25%, and you find somebody that one of their customers 30%. Is this a conversation you have with other individuals and say, hey, they go past this a little bit. There is some risk, but all the other things are green light.
Yeah, we look at the deal as a whole, right? So, for
Yeah.
example, if their biggest client was, say, the biggest client was 50%, half their revenue, but we knew that with our existing client base, we were confident we could triple the revenue in 3 years just by selling into our client base what they do today. Okay, that 50% shrinks pretty quickly, right? That probably would not be as material to us. Still a hard deal to get done because somebody on the board is going to raise the point and correctly. But so that's what I mean. You look at the deal as a whole and say, okay, this is still going to be a positive for the organization, but that deal gets done faster, easier, and probably at a higher valuation, certainly as a revenue multiple, if that 50% is 25%.
Yeah. And then do you turn that over to somebody else and then they come in, look at your package and then go make an offer to them, or you introduce them? How's that go?
Yeah, so it does vary a bit, right? If there's a banker involved, or whether it's me just calling people I know, or it's a company that we've been working with for a long time and it comes off. So it really kind of varies. But generally speaking, it's let's take the example of where a banker's brought a deal to our attention, right? I'll often do the original phone calls, or a group of us I try and stay as kind of the contact for the founders that's kind of outside of the negotiation, because let me rephrase that. So we've got a deal going through. We'll look at them. Often I will help frame up the business case for it. So this is why we should buy this firm. It solves these problems for us. This is the potential inside the organization. This is why it would make sense for the longer term vision for Valtech. And if there's sort of general agreement on that, then the global M&A team will come in and do the actual negotiations of valuations, deal structure. I'm not involved in that at all. Where I do stay involved is as this kind of backdoor for the founders. Again, it's not like I can change the outcome. Don't call me and tell me you want twice as much money, because I can't write that check. But what I can do during the negotiations is give you clarity on maybe what's happening. So if the deal feels like it's slowed down, this happened in the real world, the founder called me and said, look, we were really going quickly, and then all of a sudden things are like, come to a halt. What's happening? Well, what happened was that 2 of the people got COVID and were out, and we just didn't have any people that could do the work for 2 weeks. But they had no way of knowing that without having a back channel to have the conversation.
And what happens when you don't know really what's going on, and your mind starts squirreling? Yeah,
absolutely. Right, because you've got a lot rest. Like, it's just, you can spend a lot of sleepless nights, and I can help avoid those sometimes if I can have that conversation. Again, just bringing clarity from our side on what's actually happening. And then it also helps in the integration afterwards, because often the negotiation process is pretty fraught, right? You're going back and forth.
Yeah.
Negotiation, it's kind of intense. But the day you sign the agreement, we got to work together. So having somebody who wasn't caught up in that fray can sometimes help simplify the integration activities after the acquisition.
Yeah. So we talked about the financials of the business, the business model, the certainty of the revenue, the process, turning assets into cash flow, competitiveness, a little bit at there, customer concentration. What do you see as, and we didn't talk about the people, like who's running it.
Exactly. Yeah.
Yeah.
So 2 pieces there, the management team and then general employee turnover, right? Yeah. So listen, especially in the technology industry, I know right now there's layoffs. I think it's probably a moment in time, not a long-term thing. There's not enough talent for us to power the economy, the technology economy. So we're all looking for the best available talent. So your attrition rate is really critical. Things like Glassdoor reviews are something we really pay a lot of attention to. We'll often talk to former employees. You can find them on LinkedIn, because we know if the prospective company we're looking at gives us the name of
that's pretty easy to go.
Be good, right?
Like, hey, I'm going to go on LinkedIn, and you're not allowed to talk to my previous player. Well, I'm just going to go right to LinkedIn.
Because the industry's small enough that we often know them, right? Like somebody in our company will know somebody who worked for them, so you can get some back channel information. So like that's really important, because that tells us more about the culture really quickly than all of the plaques saying we value teamwork and whatever on the board, right? So that's one mechanism. Quality of the management team is critical. If you don't have a team that we feel can grow into the kind of operations we're going to require, because there's a lot of work to go from a company which is founder led to one that is aspiring to much larger things. We have to feel like the management team can rise to another level, and it's a hard thing to define. It's more of a gut feel thing. But if we don't see that capacity or that ambition, it's again harder for us to do a deal.
Yeah. Is there anything that just what you see as the biggest deal killers, if everything looks passes muster?
there's a few things. Maybe the most troubling is don't hide anything. Put your best first forward. Look great. It's a first date, right? Like, don't
buy new
open
clothes,
with your dirty laundry.
take a shower, get a haircut.
But if the entire executive team are related to each other, don't hide that in the first meeting. It's not a detriment necessarily, but if you hide it, then it feels like there's something to hide. Yeah. Right? If you actually own the building you're leasing, but you're doing it through 3 shell corps, and don't let us know that's what you're doing, then when we discover it, it's going to be like, we can't trust these guys. So that's one of the things I'd encourage you. Like, don't play games. Maybe you won't get caught, but you probably will. Right. And then it's like, now we don't trust you, and do I want to work with this person? And that's a deal killer. And that's happened a couple of times. The other big one is just to make sure you're running the company, because if, between the time a letter of intent gets signed and the time the deal closes, if your revenue drops by 25%, that deal's not going to close, or at least it's not going to close with the kind of deal that was proposed at the beginning. Right. So like, you got to keep running your company and act as if this deal's not going to happen, because A, it might not. But B, if the company slows down, then you're not going to get the deal.
Yeah, so that's where it came handy, your rear view mirror about having Shannon run the company while you were selling your company.
Yeah, certainly. Like, again, it was good advice, and I'm glad we were able to do it, because it makes a big difference. That can stop things. Certain things around financials, like make sure that you've invested in decent financial help. Ideally years before you go to market. We had one deal that didn't proceed because our accounting team couldn't get comfort with the financials of the firm we were buying. And so we just simply weren't able to get the letter we needed from them to go to the board to buy the company. We got it straightened out. It took more time, but that could have killed that deal had we not been persistent in figuring it out. So it's worth investing. You need a level of accounting rigor to sell your company that you don't necessarily need to operate your company. And you need to invest in that 2 or 3 years before you go to market, so you can see the track record.
Yeah, the financials tell the story. The business, the language of business is accounting. Yeah.
And it has to be a story that when you press on it a little bit, doesn't collapse really quickly, right? Like, you have to have some support behind it when it's looked at, right? So
exactly.
And that's the reality. So again, it's the sort of thing, don't rush to market. The right time to begin planning to sell your company is not 6 months before you want it sold. It's 3 years and 6 months before you have it sold. Sometimes that's not possible, right? Divorce, disease, death, whatever. But if you can, get alignment from your shareholders, right? All the interested parties 3 years ahead of time. Start thinking really hard about what levers you can pull to increase the value, and then what things you can do to make it easy to buy. So by the time you go to market, it becomes an obvious acquisition for someone that can be done quickly without any hairy things showing up in due diligence. That's kind of the ideal model.
Yeah. Wash your car before you sell it. Yeah. Exactly.
Yeah, do the repairs.
Randy,
yeah.
Man, this has been fantastic. I really, really appreciate the time you spent with me today.
Oh, not at all, John. I appreciate you doing this, and I'm sorry that I actually scheduled this on the Friday of a long weekend. If I'd realized, I would have not put it on your calendar at this date. But I appreciate you hanging in there.
Yeah, no, it's fine. It's perfect. So let me stop that.
I hope this video has inspired you. If you need help buying your first $1 million business, make sure to visit me at dealflowsystem.net. If you like this video, make sure you subscribe down below. Comment on it, share it, tell everyone about it. And thanks for watching.